called and all right, everyone. Welcome to the April 19th, 2023 investment meeting of the NYCERS Board of Trustees. Ms. Winery, will you please call the roll?
Good morning, Chair, Mayor's Office.
Brian Berge, representing Mayor Eric Adams, with Kevin Liu attending as well for the Mayor's Office of Pensions and Investments.
Comptroller's Office.
John Dorsa, designee for Controller Brad Lander, and I'd like to note that Allison Hirsch will be joining us shortly, and upon that time, she will take over as the designee.
Public Advocate's Office.
Elizabeth Guzman for Public Advocate, Jimani Williams.
Borough President Manhattan. Borough President Brooklyn. Borough President Bronx.
Janet Peguero, representing for Bronx Borough President Vanessa L. Gibson.
Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island. International Brotherhood of Teamsters.
Ruben Torres, Lawrence Bosley, and Julie Colby for President Gregory Floyd.
Transport Workers Union.
Dave Katzman for TW Local 100 President Richard Davis.
And District Council 37.
Robin Roach and Ray Santander on behalf of Executive Director Henry Garrido.
We have a quorum.
Fantastic. I'd also like to acknowledge the presence of staff and I believe also trustees from the Board of Education Retirement System who will benefit from today's presentation. Can such folks please acknowledge themselves for the record?
All right, so Antonio Rodriguez, New York City Board of Education Retirement System. We are represented by Trustee John Dorsa from the Comptroller's Office, as well as staff, and we will take up this these items at our Executive Committee meeting tomorrow, Thursday, April 20th at 1 p.m.
Fantastic. And are there any other trustees from the system other than John? Or
I do not believe so.
All right. Well,
I think I'm enough.
Yes, I've heard as much about that. All right. Well, I think with that, John, I will hand over the public agenda for your team and look forward to what you have to show us today.
Great. So we have we only have 2 items to address in the public. So I'd like to turn it over to Steve Meyer to give us a welcome and an opening and basically tee up the second part of the public session. So Steve, turn it over to you.
Thank you, John, and good morning, trustees. It's good to be with you today. John, I don't have the agenda in front of me. I have preliminary updates that are not in public session. I apologize if I seem unprepared. I thought I was prepared.
So the first item or the real item is the strategic asset allocation. So I didn't know if you wanted to give a brief introduction before we turn it over to Ed.
Sure. I apologize, John. Sure. Thank you for that. So obviously, trustees, as we have had a change in legislation at the end of last year that increased the basket clause. It's actually given rise and necessitated a review of our strategic asset allocation. We started the process in January. I actually put together some thoughts on considerations we'd want to think about as long-term investors. Ed Berman then took that and actually culled it down and improved it dramatically. And he's going to go through some of those ideas today. We actually have also been working with the consultants of all 5 of the plans, including NYCERS, to really get a sense for what their capital market assumptions are, and then understanding the assumptions that underlie those assumptions. So we've actually met with all the consultants at this point, and we are in the process of putting together a matrix, which we'll share with the 5 different plans, of course, the trustees and NYCERS as well, of what that looks like. Again, the idea isn't to browbeat any of the consultants to change their expectations, recognizing that no one has a crystal ball, and that we all have different expectations for future returns, correlations, and risk. So sorry. with that, we have put together a committee within the Bureau of Asset Management that includes myself, includes the two DCIOs, Petya Nakalova and Anash Kazilla, as well as Ed Berman and John Mercerberg and Robert Fang, really to undertake the analysis working with the consultants. So our expectation is to be able to come back to you with more substantive information in the coming months. Our hope is that we can wrap up the strategic asset allocation review and put that in front of yourselves for consideration in September, with the idea of maybe wrapping this up by October, so we can use, if there are changes, we don't want to assume that there's going to be changes, but if the trustees decide to make changes to their asset allocation, we'd like to be able to incorporate any changes to the private market investments in our pacing plan for 2024 and beyond. Just as a reminder, the basket clause, again, we work off of very old legislation, and I'm told dates back to the 1930s. And that legislation obviously has been amended many times over the years, but it basically used to work off a very old-fashioned concept called the legal list. And if the security of the asset types were listed on the legal list, it was allowed to be in the portfolio. If it didn't meet those criteria, it wasn't on the legal list, it would then fall into the prudent investment basket. And that's why this legislation is called the basket clause. And as a reminder, at the end of last year, Governor Hochul signed into law an increase in that basket clause percentage, that basket percentage, from 10% to, from 25% up 10% to a maximum of 35%. So in the past, we've been dealing with somewhat of a constrained opportunity set as a public pension plan portfolio manager. But that is now in a position where we'll be able to be more impactful, hopefully, on delivering those returns. Okay, I'm actually being handed a note that John, we may want to put this off only because I understand there's a problem with the slides that Ed was going to deliver today.
Oh,
so I apologize for that. I think we're having some technical. I see people running around trying to reconcile it, but perhaps we want to go into another item and then come back to this.
so we have one item that we could go into executive and then come back out and do public at the end, which is not unheard of. If there's no objections from the board, we can handle the matter that we have in executive and then come back out into public to discuss the asset allocation.
John, also, and trustees, I'm here to answer any questions you may have about that strategic asset allocation process. As most of you know, if not all of you know, the strategic asset allocation decisions that the Board of Trustees makes is really going to be the driver of performance. So traditionally, the performance outcome of a portfolio is driven over 90% by these strategic asset allocation decisions that you're making. Typically, the reviews are done every, it depends, every 3 to 5 years. The idea is to do it over a market cycle and over a business cycle. And as conditions change, to update those assumptions. And the assumptions basically are what the expected returns are across asset classes from a beta perspective, meaning not considering active management above market returns. The correlations between those assets as we look to have a balanced portfolio, as well as the risk associated with those returns, the volatility of those returns. So those conditions, those assumptions change. And as I said earlier, we're spending a lot of time with the consultants to try to understand what assumptions they incorporate into their assumptions. So what are the underlying assumptions that they use as building blocks? For example, we had a call just yesterday with the BERS consultant. It was very interesting. They tend to focus more on capital market assumptions in the 20-year space, whereas the other 4 consultants really focus more on the 10-year space. So we're just trying to get a better sense for how all that works. We will be putting together a matrix. So just for informational value, we're going to rely obviously on your consultants' views, but just information value about the dispersion of expectations that are out there. Again, it's always uncertain what happens in the future. Perhaps even more so right now. I have remarks that I'll make in a little bit about preliminary performance, but These are uncertain times. We saw a lot of volatility in March associated with regional bank concerns. We're probably at a turning point in Fed policy where there's probably going to be one more hike and perhaps a pause. We also have significant interest rate hikes that have occurred over the course of the last 13 months that operate with a variable and delayed lag. So we haven't really seen the full bite or the full impact of the rate hikes that have already occurred on the real economy. And then the real economy will actually drive what occurs in the financial markets as well. So uncertain terms, we've got some geopolitical concerns. We've got a war that continues to be ongoing in Ukraine, and an increased level of tension between, say, the Chinese and the U.S. Government. So interesting times.
So before we move forward, I just want to note that Allison Hirsch has joined us as designee for the controller for both Board of Ed and NYCERS. So I just want that to be reflected in the minutes. With that said, since we're still waiting on the slides for the asset allocation, we can take some questions now that Steve can answer, or we can move into executive and then we can come back into public after we're done with an executive session. I'll leave that to the will of the board. I have no strong opinion either way.
Yeah, I just have an open question. Good morning, Steve.
Hey, Larry.
With the basket clause being expanded, there's been some discussion about not really making too much change to the alternative that we invest in, the size or the percentage of the alternatives. Is that something that you guys are looking at now, or are you actually looking to make greater investments in the alternative space?
Well, it really depends on the outcome of the optimization that the consultants will run. So my expectation is you tend to have higher levels of return in the private asset space. And just as a reminder, private assets are not just private equity, but also private credit, infrastructure, and core and non-core real estate. If I had to guess, Larry, I think that certain asset classes are particularly attractive in the current environment. Infrastructure is a natural inflation hedge. And by the way, infrastructure asset, the marks are actually higher because those assets are typically, the contracts that underlie those assets are benchmarked to CPI, or the equivalent in the external markets, non-US markets. So they tend to perform well. Private credit, I think, will perform and deliver significant returns given the fact that the base rates are so much higher and actually credit spreads have widened. I think the disruptions we also saw in the regional banking sector last month will probably constrain the amount of bank activity and lending, which means credit should probably be that much cheaper and less getting done by banks and more getting done in the private sector. But I don't want to pregame this. So I look at the trustees. It's our job to deliver the information. We advise, you guys have decision rights. There are also some interesting things too, Larry. I believe that the interpretation of the basket clause, even though it's one set of regulations, it varies. The legal interpretation of what falls into the basket may vary. So certain forms of real estate where we have look through to the underlying assets, that's not in the basket clause. Certain forms of infrastructure where we have strong look through to the underlying structures, it's not in the basket clause. Private equity, 100% is. If there's any venture capital that is private credit, that's 100% uses the basket clause. High yield above a 10% allocation eats up some of the basket clause percentage. And finally, non-US equities, because they're, again, it's old legislation, but they're thought about as being more price volatile and less liquid. So I'm not so sure it's the case anymore, but they eat up basket as well. So it may be the fact that the consultants, and with your judgment, will be that maybe we should allocate a little bit more to the non-US equity markets as well, given the fact that they've underperformed US markets for over a decade, the fact that the US dollar is very strong, and currency effect of appreciation of non-US dollar currencies may be a tailwind.
So Steve, on that note, I understand the tech issue has been rectified. And we have slides that are ready to go. Ed is here. Larry, if that answered part of your question, I think that once we hear from Ed and get a broader sense of the entire project, that would be a good segue into additional questions. And I'll just say this, I think Steve said it, and we'll say it again. We encourage trustees to ask questions and be engaged. This is our single most important investment decision, is how this fund will operate for the years to come. It's not a decision we should be taking lightly. Ed's going to do a very thorough presentation. Callan is on the line. They are a great resource.
They've been
To
great.
the NYCERS trustees. Siegel Marco is a great resource to the BERS trustees.
Yeah.
We should be mindful of that as we move forward. And I also would encourage folks to think about asset classes we haven't talked about in years that we may want to just have somebody look at. This would be the appropriate time. And remind everybody, there is a difference between asset allocation and implementation. So right now we're talking about asset allocation. They do go hand in hand, but one should help inform the other. So let's just be mindful of the fact that we need to build the house before we can furnish it. So
John, if I could also add, our hope, our expectation, and our commitment is to come back to the board, the NYCERS board, on a monthly basis, just with updates and information. And we're also talking about potentially putting on some educational seminars. We've actually had a couple of these things we've done on the Thought Leadership series on Friday mornings, where they've been more focused. We've been trying to get them more focused on some of the areas or topics that we may want to be considering, not just from a product or an asset class type, but also the portfolio construction, the considerations that go into a strategic asset allocation review. So there's a little bit of method in the madness there that we're trying to make sure that everyone's up to speed. To the extent you're not able to dial into those Friday morning calls, you know, we can do things on a one-off basis as well. We're here to support and service. We want to be a resource. So, you know, I know sometimes when we're on these calls, if anyone has a question that they feel is naive or would prefer to ask it in private, call me. I'm happy to go through anything that we're talking about in a more personal way.
Steve, Ray Santander here. Just may I ask a
Morning, Ray.
quick clarification of something that you just said. Did I hear right that non-US equity has underperformed domestic equity in the last 10 years, or has it performed better than?
It's underperformed US markets. Actually, recently, to steal my thunder, but year to date, the European equity markets are up in the low to mid teens. So they've had a nice recovery, but yeah, the US has dramatically outperformed. I think we were stronger coming out of the global financial crisis, Ray, and that certainly helped performance. We also had very low rates. You know, the capital markets kind of are a little bit different. You know, they're more dominated by banks in Europe. Banks actually came through the global financial crisis in Europe, particularly in a period where they needed to have a process of repair that took balance sheet repair that took years. But you know, that's largely behind us. So we do think it's reasonable to expect some mean reversion or some outperformance in non-US equities at some point.
Okay, thank you, sir.
Sure.
So with that, let's turn it over to Ed Berman, the director of risk in the controller's office, and let's hear from Ed. And then if there are questions, interject, raise your hand, and this should be a conversation rather than a presentation that just goes to the board. We want to make it interactive.
Yeah.
So Ed, it's all yours.
Thank you, John, and good morning, everyone. So what we want to do today is to give you a sense of some of the challenges we're facing with the asset allocation, some of the internal discussions, And as we all know, asset allocation is probably one of the most important decisions facing any system. About 90% of returns are driven by asset allocation. The rest is manager selection. So it's clearly an important question. And, there's a lot of technical details, a lot of statistical jargon, like mean variance optimization. But ultimately, what we want to do today is just give you a sense of the process and some thoughts around the issues for this particular year. So can we have the first slide, please? So fundamentally, there are very few components to the asset allocation process. First of all, we start with so-called long-term capital market assumptions, where we make some projections for the returns for asset classes for the next 10 years or so. We then take it through a statistical process where a computer basically finds the most optimal allocation, and we're done. So what is the long-term capital market assumption? So obviously nobody knows the future. There's no crystal ball, as Steve reminds us probably every day. Ultimately, the assumptions are based on history, because history is the only thing we have. It's the only guidance star for all of our decisions. And fundamentally, there are two kind of extreme approaches that different people take in the assumptions. On the one hand, you can just simply take the historical time series, the performance of equities, rates, of the economy, find some historical trends and just mechanically project it forward. On the other extreme, you can say that history is history, it's done. The future will be different. And you'll build the assumptions based on the fundamental understanding of the economy, how you think the GDP will evolve, whether rates will be, whether inflation will be. So it's basically from the fundamental bottoms-up approach, and the returns is a fallout from this process. I think in reality, most people follow some kind of blend of these two approaches. But no matter what it is, history is there. And history is always a fundamental bedrock of any long capital market assumptions. And that's where we'd like to argue that, we always say that this time is different. It never is, but we are at a somewhat unique period in time. And it's simply because if you look at the past 25 years, and 25 years is about the period of time that people take as their guiding historical background. But the last 25 years were very unusual. And you can see it on the right-hand side of the screen. So we have four notable major crises during this 25-year period. So we started with the dot-com bubble crisis, year 2000. And that was as traumatic as it was, more of a standard run-of-the-mill market crash. They happen every 10, 20 years. There was probably nothing that unusual about it. That was followed by the global financial crisis, year 2008. That was different. The financial crises usually come about every 100 years. The previous crisis of this magnitude was in the 1920s, late 1920s, that ended up with with depression. We're still living through the aftermath of the GFC. On average, it takes about 10 to 15 years to work through the damage done by this crisis. Unfortunately, a few years later, in 2009, 10, 11, it was followed by the European debt crisis, which was really just an extension of the global financial crisis, the same driving principles. And just as Steve mentioned now, part of the reason why European stocks underperform so strongly and the European economy is underperformed on average is most likely the result of the European debt crisis. Again, it's a type of financial crisis. They do not happen very often. And finally, today, our current environment, even though we're kind of in a normalizing stage, but think about the past few years. We had the global pandemic. Last time it happened was 1918, which is the Spanish flu. We have inflation. Again, when you go back to the 70s, 80s, or maybe even before to find comparable periods, and of course, a major war in Europe. Putting it all together, COVID, inflation, and war, the most appropriate comparable period to me is 1918. Again, it's a 1 in 100 time event. So the past 25 years are unique to me, not because of so many crises, that's not unusual, because this crisis was so unique, idiosyncratic. And I don't know what the next 10 years will be, but I guarantee you it will be very different from the past 25 years. So the world is very complex, and it's actually getting more complex every year. And the 160 countries, we all interact with each other and come in conflicts. And it's kind of hard to identify the main themes. That said, can we have the next page, please? We came up with the 3 main themes that drive asset allocation and basically determine the shape of the world in the years to come. And these themes are inflation, the GDP, and uncertainty. So inflation obviously has been the talk of the world in the past 3 years. It created a very dramatic impact on asset managers, asset owners, and pretty much on the rest of the world. It changed our return assumptions, it changed our correlations, which is important for the multi-asset portfolio. Most importantly, it created a huge uncertainty. What is the future? Are we going in the period of high inflation? Will inflation be moderate? Will it collapse to the pre-COVID days? These are fundamental questions that ultimately will determine the asset allocation, the most optimal asset allocation. The GDP growth, the GDP, which is the rate of expanding of the economy, is fundamental to the economy and the markets. This is the income generated by the economy, which ultimately flows into the financial products, into the margin returns for the companies, into dividends on stocks, into the growth of these stocks, and the returns on the bonds. The GDP growth had been very low before COVID. What is the future? And the last theme we have is the uncertainty, and we call it radical uncertainty. The world was always unpredictable, and we believe it will be even more so in the future. So we'll go over each of these 3 themes in details, and for each of these themes, we'll try to answer 3 questions. First of all, why it is important. Second, what drives it? And the third question, how do we express this theme in the asset allocation? So let's take that from the top, inflation. We have the next page, please. So why is inflation important? Fundamentally, inflation is just change of prices. And obviously, nobody likes when prices go up. It's natural for people. But it turns out that it's not that inflation is damaging. It's the change of inflation is damaging. It's the uncertainty that it introduces for businesses, for consumers, and for the international trade. Clearly, inflation increases cost of servicing debt. Anybody who has a floating rate mortgage obviously is hurting today. Anybody who managed to secure a fixed rate mortgage, which is actually the majority of the United States, is doing quite well. We talk about inflation as being a single number, but in reality, there's a range of inflations. Even domestically, here in the Northeast, our inflation tends to run lower than in California. That alone creates a lot of uncertainty. This environment is much worse in Europe. We have a single European Central Bank, but 27 national economies. And at the peak of inflation, the spread was tremendous. It was between, going by memory, about 6-7% in Spain to about 19% in Estonia. Even today, as inflation coming down, the spread of inflation within the European Union is strong, and it creates additional barriers for trade and investment. Inflation reduces real incomes, and we saw it as the effective real compensation for most workers has been declining during this period. It means lower consumption, means lower manufacturing, again, slowdown of our economy. It's clearly damaging for anybody on fixed income, for the pensioners. As bad as it is for developed economies, for the emerging markets, it's a different story. A lot of emerging market countries borrow in dollars and they import commodities and food. In the extreme, inflation creates starvation. Some countries may not afford to buy food. And as bad as inflation is, it's the deflation that we really worry about. And my favorite example here is Germany in the first half of the 20th century. So this common narrative that inflation in the Weimar Republic ultimately led to the rise of the Nazi and to the Second World War. It's actually not exactly so. Inflation in the Weimar Republic was defeated within a short period of time. High inflation, hyperinflation was followed by strong deflation. And it's the deflation in Germany, in Weimar Republic, led to huge unemployment, collapse of the economy, and that's what ultimately led to the rise of the Nazi Party. So what drives inflation? And quite simply, the short answer is we don't know. There used to be better times, simpler times, and maybe like 10 years ago, when there's a common model that the monetary supply leads to inflation. Simply put, more money, more inflation. Less money, inflation is gone. We now understand that it's much more complicated. It's a multidimensional problem, and we really do not have a good grasp on it. And here we have a quote from Oliver Blanchard, which is a well-respected economist, former chief economist of the IMF. And I'll just read it in full. Inflation is fundamentally the outcome of the distribution conflict between firms, workers, and taxpayers. It stops when the various players are forced to accept the outcome. So from this short quote, you see that, first of all, there are many moving parts, and it's not clear how to bring inflation down. And essentially, the only lever we have is the central bank policy. So we don't know, we don't have a commonly accepted model of inflation, but we have some ideas of what drives inflation and what led to this high inflation environment. First of all, the globalization versus regionalization, the role of China. And we all know there was a spectacular collapse of inflation in the 20th century, in the early 21st century, when inflation was declining fairly straight line from the late 80s till fairly recently. And large part of it was the transitioning of manufacturing out of the developed world into the emerging country, mostly China. And that's ultimately the wage arbitrage. So instead of manufacturing in a high wage environments, you move manufacturing to a low wage environment. And that, of course, allows prices to fall, prices decline, which creates low inflation environment. The future of this process is highly questionable. There are a lot of discussions. I'll be happy to bring it up, but just talking about globalization will take us another hour probably. We know that the state plays an important role in inflation. And that is done through both fiscal and monetary policy, even though it's not a straightforward translation. It's not necessarily so that an activist monetary policy will lead to inflation. It may under certain conditions. It's not necessarily so that activist fiscal policy or increase of state borrowing will lead to inflation. But again, it may under certain conditions. We know that the patterns of global consumption and income distribution have an important impact. And in particular, the story of the past probably 25 years or more is the growing inequality of wealth distribution and income distribution. And what's happening mechanically as the wealthier class accumulates more income and assets, they have low propensity to consume. The consumers in the lower income level need to borrow to consume, and ultimately the consumption slows down. Prices come down. There's less need to demand. So the inequality of wealth and income leads towards falling prices and towards disinflation. We know that geopolitics plays an important role in inflation, and that clearly, I think a lot of PhD dissertation will be written in the years to come about the reasons for this inflation. But I think it's hard to deny that the war between Russia and Ukraine created a spike in prices for agricultural products, for some of commercial commodities, and disrupted the shipping pattern. And clearly, the geopolitical conflict creates a spike in inflation. And finally, there's a question about the role of US dollar. And it's actually not a simple question. Again, it's not a simple projection that declining of the dollar role as reserve currency may necessarily lead to inflation, though it may. But dollar being a unifying force in the global trade creates an efficient mechanism for transmission of inflation. Now, inflation stops being a national problem and becomes an international problem. Much like inflation within the United States will be quickly transmitted to the rest of the world through the dollar. Much the same way, inflation, for example, in China or other major trading partners will be imported back into the United States through the channel of dollar being the global currency. So how do we express the inflation views in asset allocation? And we have the next page, please. So here we think about the two extremes, which makes it a little bit easier to kind of frame the discussion. The low inflation environment versus high inflation environment. In the low inflation environment, and think the pre-COVID days, the good years of 2015, 2018, in the low inflation environment, you expect the stock bond correlation to be negative. And what it means simply, when stock prices go up, the bond prices go down. It's a positive environment for a multi-asset portfolio. It's a good environment for your system. That's when the 60-40 portfolio really shines. That's what's constructed for. On the negative side, fixed income plays a much reduced role in the portfolio. It still provides some risk diversification. It provides cushioning of risks. But clearly, in a low inflation environment, the carrier, the interest being earned by holding fixed income is much lower. So there's less of capital appreciation and less of dividends coming from fixed income. On the equity side, it's the growth equity that will shine. It's not an accident that internet stocks took off in a low inflation environment. As investors look for the yield, they will reach for growth over value. And finally, private assets, private equity in particular, tends to have a very strong tailwind, exactly for the same reason. In a low inflation environment, cost of leverage, cost of borrowing tends to be low. Investors look for additional yield, and private equity is a natural place to deliver on both. The other side of the world, the high inflationary world, looks very different. Now the stock bond correlation is positive, and that's exactly the environment we've seen in the past few years when stocks and bond move down together. That's not a good environment for the 60-40 portfolio. It's not good for a multi-asset investor. On the positive side, now treasuries and credit play a much important role in the portfolio. Like today, by investing in super safe treasuries, we can earn 4 or 5% yield. Investing in buying investment grade gets us 6 to 7%. This is good carry. These are good returns. The equity exposure becomes almost the flip side of low inflation. It's the defensive equities that outperform. Value probably has more place, and commodities may benefit under some conditions. It's not a given shot. And finally, the real assets, think infrastructure, think real estate, may provide positive returns. So that was inflation, theme number one. The second concern we have around asset allocation, can we have the next page, please? The next concern is the GDP and the future of the GDP growth. And here we talk about real GDP. And just to remind, the numbers you see reported in the press, these are nominal. This is what's reported by the statistical agencies. What's important is the real GDP growth, meaning adjusted for inflation. That's what matters. And clearly, the GDP growth is the bedrock of the economy. Everything in the economy, from employment, unemployment, consumption, financial returns, everything revolves around the GDP. There's a reason why European stocks underperformed American stocks in the past decade. It's all about the GDP growth. It's also important to keep in mind that the GDP growth, or the rate of growth, strongly influences central bank policy. And that's have a counter-cyclical impact. If the GDP growing too fast, the Federal Reserve will get concerned about the economy overheating, which may create inflation. And they typically tend to hit the brakes to increase the rates. When the economy is slow, the central bank will try to stimulate the economy, either through cutting rates or by initiating the quantitative easing program, much like we had in the past decade. Expanding economy clearly creates a positive environment for equities. It's a rising tide lifts all boats. Equities will rally. And probably the most important point about the GDP growth, keep in mind that the rate of GDP growth ultimately determines the long-term interest rate. So as a rule of thumb, if the GDP is growing at about 5%, which is probably not achievable, I think for the developed economy, it's more like 2 to 3%, you probably expect the 5 to 10-year treasury note to yield about the same. So a 3% GDP growth will create about a 3% yield for the treasuries. So what drives the GDP growth? And we have the next page, please. And here we have one single formula for this presentation. And there are really just two components that go into the GDP growth. It's the growth of labor and the growth of productivity. Let's just take it in steps. Starting with labor. I think we all heard about the problem of aging demographics. And obviously we have it here in the United States, but it's actually a problem everywhere. It's probably more acute in Japan and in South Korea. As number of children is declining, people get older and they retire, and retired people don't work. The low fertility rate is becoming one of the major policy issues for all countries around the globe. The neutral fertility rate, which is about 2.1 children per woman, is what's needed just to maintain the population density. Almost no country other than Africa or some countries in the Middle East maintain this level of fertility. Our level of fertility is about 1.8, which is actually quite high for the developed countries. It's much lower in Europe. I think South Korea has one of the lowest fertility rates. It's like 0.8, which is a disaster. There's a lot of discussion recently in the press about the declining fertility in China, which is one of the most important markets. And actually just reported this week that India, for the first time ever, the population of India exceeded the population of China, which will have strong repercussions for the developing of the economies. Labor migration is a big component of labor growth. And it's obviously became a political question recently, but simply put, one of the easiest ways to increase labor is just to import. So migrants create a strong, a positive impact for the GDP and increase the amount of labor available for manufacturing. The other side is the labor force participation, and that's an important question. Again, not very well understood. In our country, in the United States, labor force participation actually fairly low for developed countries. Going by memory, it's about 62.8, 63%. It took a huge step down during COVID. It's about a few weeks ago, it's actually recovered to the pre-COVID days. But, a simple way to increase the amount of labor is just to improve labor force participation. And it tends to be high in Europe. Part of it may be just stronger support for mothers and more childcare, so more women can actually enter the labor force. But that's again one of the components that will determine labor growth. And retirement, right? The retirement age. I mean, we tend to retire around 65. There've been a lot of political noise in France recently when they tried to move the retirement age from 62 to 64. But clearly, I think the way the economy is developing, it's probably reasonable to expect that people will be retiring later. And even after retirement, some people may need to take part-time jobs, which will also be in part of the labor growth story. So that's labor growth, and there are a lot of moving parts there. The other side is productivity. And productivity, quite simply, it's amount of products or amount of output produced by a worker per hour of work. For reasons we do not totally understand, productivity growth has been in decline during the 21st century. I think at the peak, the best productivity period was in the 50s and the 60s. We know that productivity growth is heavily influenced by technology. Like one of the biggest spurs of productivity took place in the early 20th century. And that's mostly because of the invention of electricity and steam. And notice I say 20th century, both steam and electricity were brought to market in the 19th century. Truth of the matter, there's a very long lag between invention and adoption. To give you an idea, electrical motor was patented in the 1870s. It was fully incorporated in manufacturing only in the 1920s. And it's simply because a lot of factories were structured around the steam engine, which required vertical integration, where you have one steam engine and a single belt drove all machinery. With the electrical motor, you need to organize manufacturing horizontally. It took about 50 years for the entire world to figure it out. Much like when computers, when the PCs were invented, and this is 1980s, there were expectations for a spike in the productivity growth. It did happen in the 90s. It was not as strong as people expected. And I think anybody who spent a lot of time with computers, and this probably goes for every single person on this call, knows that computers can be mixed bag. Just to give an idea, this presentation we're looking at, it probably took a few hours to put together in terms of content, but it took us 2 weeks to figure out the layout. So computers will not necessarily create more productivity. Much like today, there's a lot of talk about artificial intelligence and potential impact on the productivity growth. Remains to be seen. It will probably take a fair long time before AI, ChatGPT, and similar systems will actually find a way into manufacturing and will identify a productive use for this technology. So we don't know fully what drives productivity growth, but we have some ideas. So we know that trade imbalances may lead to slow down in productivity. And why that is so, as well know that manufacturing is a little lopsided in the world. A lot of goods are manufactured in Asia, consumed throughout the world, which ultimately has a labor arbitrage at its core. So instead of investing in productivity into machinery automation, companies may just ship the manufacturing abroad. There's no push for higher productivity. So these trade imbalances actually slow down the productivity growth. Even today, despite a strong growth in China, the productivity of Chinese worker lags American productivity by a strong margin. As I mentioned before, we know that technology and AI have an impact on productivity growth, but it comes with a strong lag not well understood, and the impact will probably come several decades later. We know that fiscal and industrial policy have strong impact on productivity. And it's simply the state has capacity of investing in R&D, which creates additional productivity capacity. For example, in the current environment with the Inflation Reduction Act that was passed in the United States recently, we see even now with a very short delay, we see an increase in R&D investments And that may actually propagate through the system, and we may expect in the next few years a spike in the productivity within the United States. So even though we don't fully understand why productivity is declining, we know it's coming down, but if you bring it all together, labor growth slowing down, productivity growth slowing down, the GDP, which is a product of the two components, the GDP growth will be slow. And that's exactly the environment we've seen after the global financial crisis. I think the big question today, going forward, are we going back to the low GDP growth, or will it be more like in the 90s, which is probably one of the best periods in recent history? So how can we express these views, and what does it mean for asset allocation? And here again, we take two extremes, the slow growth environment and the fast growth environment. In the slow growth environment, and again, this is like 2010s, right? So this is the pre-COVID environment, which is well familiar to all of us for its recent memory. The interest rates will be low, which will reduce the attractiveness of fixed income. Growth equity will benefit over value. And we see it everywhere. We see it in these market events. You see NASDAQ outperforming the S&P. You see the internet stocks going to the moon, and the FANG stocks, the Facebook, Amazon, Google, outperforming everything else. We know that it's an environment generally positive for private assets. It's probably not an accident that private equity as an asset class really took off and started developing so strongly in this slow growth environment. And unfortunately, we also know that this environment is favorable to speculative assets and bubble formation. Again, I don't want to talk much about crypto, but it's probably not an accident that crypto and the crypto bubble developed in a slow GDP growth environment. On the other side of the spectrum, the fast growth, when the GDP expanding at a higher rate, we expect that the rates and credit products will be hugely beneficial for the portfolio. We expect value and small cap stocks to deliver better returns. And generally speaking, say that the majority of active fund managers tend to be value investors. So I don't want to open the can of worms, passive versus active, but it's probably not unreasonable to expect that value in active management will probably perform better in the fast growth environment. And finally, the hedge funds. Hedge funds probably have a better chance to outperform in the fast growth environment. Again, rising tide lifts all boats. There's more assets to play with, and hedge funds have a much better environment in the fast growth environment. So we covered inflation and GDP. This last component probably gives us most worry. The next page, please. And it's the radical uncertainty. And we always think of the world as being uncertain, and clearly there's a recency bias when we think our time is the most unusual. But we can actually quantify the level of uncertainty. There is a global uncertainty index. It's maintained by the IMF. You can actually Google for it. And you'll see that the uncertainty, global uncertainty, has been on the rise from the 1970s. And again, going by memory, the index right now is almost twice the level of 1980s. So it's a measurable fact. Uncertainty is increasing, and that's why we call it radical uncertainty. And there are things that we know that creates the environment of uncertainty, so-called the known unknowns. We show them on the left-hand side of the page. We all know about the climate transition. It never happened during modern times. And there are a lot of projections, a lot of thoughts, what we do. The truth is, we don't know. We know it will be dramatic. We just don't know exactly how it will play out. China is an enormous force globally. China was almost like one of the major engines of global growth, with the GDP growth anywhere between 5 and 10%. I think it's commonly accepted now that the Chinese economy cannot grow as fast. It needs to restructure. There are few precedents in the world history of the economy of this size restructuring successfully. It creates more uncertainty. Geopolitical conflicts everywhere. The role of US dollar, we'll talk a little bit about it. The dollar is the world reserve currency, probably to the extent never happened before. It's probably reasonable to expect that at some point it will morph into a different system. And that also creates a certain level of uncertainty. Access to natural resources. Natural resources, of course, critical for any economy. And there are actually only two countries in the world that can be completely self-sufficient with the resources they have on the soil. And this is the United States and Russia. Every single country in the world relies on some degree of imports. The polarization of national politics. I mean, we obviously all know our domestic politics. It's becoming more and more polarized every year, but it's actually happening everywhere. It's happening in all countries. It's happening in Europe. You see it in Spain, in Italy, in France, maybe less so in Germany. You definitely see it in Asia. You see it in the Middle East. National politics is becoming more polarized everywhere. Artificial intelligence is a new wild card. It's something completely new. We just don't know how it will play out. And finally, which I think is very close to all of us and very important for your portfolio, is the shifting dynamics between public and private markets. So if you think about 10, 15 years ago, private markets was a fairly niche investment opportunity with unique and very appealing return potential. Fast forward to today, private markets make almost 10% of the economy. It's anything but niche. It's still untested by the market cycle. And the interplay between public and private markets, especially in the equity space, to some extent in the debt space, is untested, unclear, and somewhat controversial. So if you think about these known unknowns, if we had this conversation 3 years ago, it probably would have been a very similar list. What really worries us is the right-hand side of the page. It's the unknown unknowns. Again, 3 years ago, we knew the left side of the page, but nobody knew about the pandemic or the war or inflation. There will be more uncertainties going forward. So as uncertain as it is, there's room for surprise. So what leads towards this radical uncertainty? Why do we talk about it today? Can we go to the next page, please? It's not an accident that uncertainty is on the rise. And quite simply, it's a reflection of the world getting more complex. We probably can expect this process to continue going forward as the economies get more complex, the interaction between consumers, manufacturers, and also interaction between the global countries. The rise of China from the late 1980s to today was probably one of the main drivers of uncertainty. Ever since China was joined World Trade Organization and took the leading role in manufacturing, it's changed the trading patterns, it changed the consumption patterns. It was probably one of the largest drivers of change in the world. And the forthcoming restructuring of Chinese economy will much the same reverberate through the rest of the world. There are plenty of unresolved regional conflicts everywhere in the world. This war with China and Ukraine, as traumatic as it is, didn't come out of nowhere. It started in 2014. We see a conflict in Sudan, which again, we see it in the news this week, but it didn't come out of nowhere. There's history to it. Anywhere you look in Europe, Asia, Africa, Middle East, there are frozen conflicts. And as they come to the forefront, as they explode, that creates uncertainty for consumers, for economies, and for businesses. Access to key resources. and the restructuring of the world economies is a critical source of uncertainty. So at some point in time, the economies were coal-based. We mostly passed this point. Oil was one of the most critical commodities for the 20th century. It still is. Now we worry about the rare earth metals. There are actually very few deposits globally, and the few commercially available deposits are concentrated within the sphere of influence of China, Chile, some African countries. But access to key resources is very important for the world and creates more uncertainty. Rising income and wealth inequality at national level. And we don't talk much about it, but it's one of the reasons why the financial system becomes less stable. And inequality just mechanically leads to increase in debt levels. And it's probably not an accident. If you look anywhere across the developed world, the total debt level is roughly about 300% of GDP. The breakdown between public and private changes a bit from country to country, but the overall debt level is surprisingly similar. And that creates a high level of uncertainty and creates problems for the economies. There are also imbalances between the nations. So we hear a lot of talk about potential fragmenting of the world in the multi-block structure between China and the United States, or between China, Europe, United States, with the rest of the world somehow finding their place within these blocks. This uncertainty, which is fairly recent, again, creates uncertainty. Global warming, it's something we all talk about all the time. It's a huge theme for all of us, for our entire civilization. And as we're beginning to see the impact of global warming through, I don't remember last time we saw a lot of snow in New York. As global warming picks up and accelerates, it will create enormous disruption globally. Related to that is energy transition, which creates a lot of uncertainty about how we phase out oil and move towards renewables. So in a way, we got caught in this transitionary period when we want to get rid of oil, but we cannot afford that. And that creates, again, uncertainty. And finally, artificial intelligence, we talked about it. We talk about its impact on the GDP, on the productivity, but most importantly, it will impact people. It's probably not unreasonable to expect that a lot of people will lose their job, will need to retrain, and it will create strong changes to the labor force and consumption patterns. Again, we don't know how it will play out. So what does it mean for asset allocation? How do we translate this radical uncertainty into choosing strategic benchmark? Can we have the next page, please? There are actually ways to adjust asset allocation for the uncertainty. Most and foremost, you need to be diversified and flexible. One question we discussed internally is the frequency of the strategic asset allocation update. Should it be done once every 10 years, which is a reflection of us being long-term investors? Should it be done once a year, which is a reflection of uncertainty? How fast we rebalance, how fast we update our strategic is one way to address the uncertainty. It's how we manage the portfolio, how we rebalance it, how well we adhere to our process. One potential way to address the uncertainty is a broader use of active managers. And just want to disclaim right away, I'm not advocating currently this way or another, but it's one of the levers we may adjust. As active managers, again, may be in a better position to shift the exposures and address the uncertainty as it comes to the forefront. We need to be flexible in terms of looking at alternative asset classes. And I'm not just talking here about our usual alternatives, private equity, private real estate. Maybe we need to go further. Maybe it's timberland. Maybe it's some digital assets. The world is evolving, the world is changing, and there may be opportunities beyond of how we all invested 10, 20 years ago. Maybe it's the ability to express tactical views. Again, I'm not advocating this way or another, but the ability to express tactical views may be one of the ways to address the uncertainty as things shift. Think about the war breaking out. A strategic will be able to adjust for it. And finally, it's probably one of the most important. It's the engagement. It's engagement of staff, of everyone. It's ongoing education. As the world is evolving and changing, we cannot rely on the education received in colleges. We need to stay on top of the news and developments every day. So finally, we talk about these three themes. Let's try to put it all together. So we can think of the world as evolving in two dimensions. Obviously, the world is complex, but I think this matrix captures the main points of the future state of the world. And here on the horizontal axis, left to right, you see the GDP growth. Left, slow GDP, right, fast GDP. On the vertical dimension, up and down, is the inflation in interest rates. Up, inflation is low. Going down, inflation is accelerating. And here we can identify four very distinct macro regimes, so macro environments that have strong repercussions for asset allocation. So let's start with the upper left quadrant, stagnation. And that's the environment when the GDP is falling and inflation is deaccelerating. And that's roughly the environment where we have been before this COVID war environment. So in this stagnation environment, what be positive will be potentially rates as for the capital gains, as inflation declining rates will probably deliver capital gain appreciation. Credit will be helpful, growth equities, and private assets. On the negative side of the equation, you have commodities, value equities, and emerging markets. Going down in the grid, stagflation. That's why we have high inflation and low growth. This is the environment of the 1980s. That's the Volcker period. That's not where we want to be. Very few assets will deliver a positive return. Cash, US dollar, maybe hedge funds. On the negative side of the equation, pretty much everything else. It's very hard to deliver a positive return in a stagflation environment. Equities, bonds, credit, emerging markets, everything is selling off. The flip side of this is the Goldilocks environment. When growth is high and inflation is low. Think 1990s, the golden time for the American economy. That's where you just can't go wrong by anything. It's the everything crowd. Stocks, bonds, commodities, emerging markets, everything goes up. Cash, not so helpful, not a huge problem. And potentially hedge funds will struggle in this environment. And finally, the overdrive. When growth is high and inflation is accelerating. This environment is actually quite unusual and probably doesn't last long. And it's simply because in a high inflation environment, it's likely for the Federal Reserve to slap the brakes. And that's exactly what happened in the late 1990s. In this overdrive environment, value stocks will perform well. Industrial commodities will deliver positive return because of a high demand for commodities. Hedge funds are likely to be good performers. On the negative side is the growth equities. That's not an environment for the internet stocks. And rates will deliver losses. So this table captures the first two themes that we talked about. The problem is we don't know where the world will end up being. And that's our third theme, the radical uncertainty. Which of these quadrants will dominate the world in the next 10 years? We just don't know. So I'll stop there and open to any questions for discussion now or later.
Any questions from trustees?
Yeah, just a quick question, an educational question. I've been hearing a lot of commentators complaining about the United States is too reliant on a consumer economy. But what is the alternative to a consumer economy if that's the case, or if it's not?
Well, there are two models of economy, this consumer economy and this capital economy. And I think you're absolutely right. Consumer economy is the best way to approach it. What I mean by consumer economy, think about the United States. When it's mostly about the consumption. Consumption, of course, means people have jobs, people earn high income, people buy stuff, which requires more manufacturing. So self-sustaining economy. High capital economy, think about China, Germany, these tend to be export-oriented economies. So in these economies, there's an incentive to keep wages low for the economy to be competitive. If German cars were manufactured in a high wage environment, they'll probably be more expensive. China exports so much by keeping wages low. So ultimately, if you have high capital economy, it comes to a standstill simply because people don't consume. Because ultimately, you have this vicious loop, right? You have a job, you get income, you consume, so money is being manufactured. It's a self-sustaining economy. That's where you want to be. So when I hear about this economy being about consumption, bring it on. It's a good thing. Let's keep it.
I'd just like to reflect for the record that NYCERS trustee Dan Master from Staten Island Borough President's Office joined the meeting.
Any other questions about anything Ed covered or I spoke about earlier? There is just one note I would make. I know Ed talked a little bit about in some instances around the asset allocation, you may want to be more tactical and more nimble in an uncertain environment. I want the trustees to know, though, that the strategic asset allocation, those targets that you've given us, thus far, we adhere to very strictly. So we're not actually building up cash and we're not actually positioning in the markets or trying to time the markets. You know, the philosophy and approach is time in the markets, not timing the markets. So again, the asset allocations that you've given us to work by, we've adhered to pretty strictly. Actually, we were had a rebalance meeting right before this this call today. But it's not to say that there might not be a way to think more tactically about taking opportunities, taking advantage of market opportunities over time. And those are things that we can talk about through the process, or even perhaps through the strategic and tactical accountability review of how we may be doing things differently in order to benefit the portfolios themselves. So it's food for thought. Any final questions?
Oh, thank you very much, Steve and Ed. I was on mute. My question, with respect to, believe it was put forth that one of the options is to go towards active management, and so I refer to things that I've heard in the past. That the concept that information is so widely dispersed. That creates an efficient market and therefore an easy, and it would be tough to beat a market, an individual strategy or manager where information is so widely dispersed. And Steve, of course, with your best experience in the private sector, just just wanted to know what your thoughts on that.
Yeah, I mean, that's a great question, Ray. So as a general matter, you're right. As markets become more efficient, the ability to outperform the market and generate alpha through active management goes down. So if you look at the allocations in your portfolio for U.S. domestic equities, for example, it's about 85% passive because we don't really see a natural capability to take advantage and generate alpha. I think it is possible to outperform the market. I think it's rare and hard to find, and it's not necessarily consistent. I look at things such as our size in the marketplace. You guys have a very large portfolio. It's an advantage in certain areas. It's an advantage in terms of negotiating better economics. It's an advantage definitely in the private market space for alternative assets where we're able to, get market share and allocations into the top quartile, top decile general partners out there and negotiate, very attractive economics, sidecars, co-investment, whatever drives those fees down lower. In international markets, in international equity markets in particular, there tends to be an opportunity to potentially outperform. But again, as those markets become more efficient, again, it's rare to find good managers. At our size and scale, I should say, at NYCERS size and scale, you have a lot of money to put to work. A lot of those strategies that can outperform because they're more concentrated bets, they're more high conviction. They tend to be a little bit more nimble. And allocations, big allocations into those funds oftentimes is very challenging. So I know John Mercerberg and our equity team have put a lot of thought and time into our active management mix for developed market ex-US. And we're in the process of communicating and debating and vetting that within the investment committee in BAM. But those are great questions. Those tend to have a little bit more to do with implementation as opposed to strategic asset allocation, but they're very valid. And it is something that I think bears consideration. Again, in many instances in the public markets, large size is not an advantage, where it's more of an advantage in the private market space. So food for thought. We're still going through the process of evaluating what we'd like to bring to the trustees for consideration in that specific instance.
Thank you, Steve, and thank you, Ed.
Let's see, Effie's got his hand up. I don't know if I can unmute you if you're muted.
I unmuted
Oh.
myself. Thank you, Steve. I actually have a couple of questions. The first one, how often do you rebalance? Meaning, do you do it periodically? Like, I'm just making up every quarter or whatever, or do you do it based on the current balances? So, for example, if next week the stock market drops 20%, do you reallocate to rebalance it immediately, or do you do it based on the calendar?
Yeah, we don't do it based on the calendar. If that's a great question. So we actually have rebalance meetings at 9 o'clock in the morning every Wednesday. Those rebalance meetings, if you will, also we go through a process of assessing our cash needs to make sure we have enough cash on hand to meet capital calls as well as beneficiary distributions. But we do that on a weekly basis. We look at rebalancing. I'd say that would be more. We try to adhere to the strategic asset allocation targets that you've given us as a board, but we try to be tactical in its execution. So we look at the potential volatility in the market, how costly it would be to rebalance, and we try to be more strategic that way. So, for example, today we made a determination. We're almost at target for the equity holdings. We're below target about 2 to 2.5% in fixed income. So we're actually going to be selling some equities and reinvesting in the fixed income. Even though both of those public market allocations will be slightly below the target, given what's going on in the marketplace, we still try to balance that out and maintain overall positions that are as close to those targets as possible.
Thank you. My other question is, I mean, the correlation matrix and stuff like that we spoke about earlier is all nice, but what happens in terms of stress? How do you manage tail risk, especially given the size of the funds?
Well, that's a great question as well. We're not nimble, and we're not nimble by design. We're not meant to be moving in and out of the markets more tactically. We're more strategic. Again, that's the importance of the strategic asset allocation review. A lot of times, again, we look at correlations, we look at risk, we look at stress in the markets and the portfolio on a long-term basis. Again, we're not looking to quickly move in and out of markets. There are some mechanisms that you can put in place that we actually have in place for a number of the fixed income strategies we manage in the private credit space. For example, we negotiate with, again, after it's approved by the trustees, we do negotiate some flexibility where capital can be put to work. Your investment dollars are put to work or called when things cheapen up. So if bond prices decrease below a certain level, where credit spreads widen above a certain level, we can actually deploy capital then again strategically but tactically at the same time, so be a buyer when things cheapen up a bit. And those are the types of structures that I think, as a large public pension plan, you need to think about in terms of some degree of flexibility, but really focusing on the strategic asset allocation as the driver of long-term performance over time.
All right, thank you very much, Steve.
Sure, my pleasure.
Yeah, I have one more question, Steve. Is the takeaway from this that because of the uncertainty of the markets and the potentiality of a low GDP for a number of years, are we looking at asking us for more diversity in the assets that we invest in, or not really?
That's a great question, Larry. Meaning more diversification across another asset classes, like I think Ed mentioned timber, for example, that may perform well in a high inflationary environment. Perhaps we've actually shared that presentation that Ed just gave to the trustees with the consultants as well, just in terms of this is how we're thinking about things. And again, the consultants have great databases and insights as well into these matters. But the expectation you should have from us is that we come back to you with a very thoughtful strategic asset allocation. It may include recommendations for additional assets. It may be implemented differently, maybe more passively versus actively, depending upon where we think the opportunities are. I don't know if that's a great answer to your question.
Yeah, it is. I mean, I was looking at things like, well, could we be looking at VC? Could we be looking at hedge funds? Would we be looking at commodities, things of that nature that we may not be invested in? Would it make sense to start looking at those things and studying as to whether we should be in them to balance out the portfolio?
Those are all great questions. I know we've got representatives from Callan on the line, so but in a moment I'll turn it over to you to comment. But those are things that we actively think might make sense, Larry, in a more volatile and uncertain time. Hedge funds to have a tendency to provide good balance for the portfolio and outperformance. Venture capital, because things have cheapened up and continue to cheapen up. Venture capital hasn't performed well in the last year, and it's in these environments where I don't want to say you lean in and out of private markets, but if things are cheaper, there may be a legitimate reason why you may want to have an increased allocation to venture capital, which we've done in the past through fund of funds. But I know Anash has given some thought to that as well. But do you have any comments? I know you guys are very thoughtful on these issues as well.
Yeah, no, I believe that we're looking at everything as far as further diversification, Larry, and we're talking also to the alternative consultants that you have to talk about what their ideas are within their specific asset classes, where potentially something like timber could be attractive with its hedge on inflation. So yeah, we're considering more diversification, but currently you already have a very diversified portfolio. So I would think that most of the diversification or new diversification would come within the alternative asset classes, as opposed to, we have a lot of equity and fixed income. And then back to Effie's question on stress testing and the tail risk. I think a lot of that comes in during this process. So you're looking at stress testing the portfolio in different times, so you don't load up on something that might look attractive today, but you want to consider, what was the biggest drawdown in some very bad periods to keep you, structured in a way that you don't overload on one asset class.
Steve, may I make a point here?
Absolutely, Ray, please.
With respect to venture, I was here when we were in venture, and it was Larry Schloss's convincing the board to get out of venture at that time. So this is certainly 10 years ago. The reason being that we couldn't get a decent allocation. I mean, as big as we were, the best funds, we just couldn't get in, and a $5 million, for example, allocation would be, meaningless for essentially for NYCERS. So that was the reason at the time, in addition to which the VC firms at that time they were not interested really in dealing with a public fund and all the paperwork and the time. And, it's a different process than, as you well know, than dealing with, a family office or an endowment or a university. So I just wanted to give a bit of an institutional anecdote about that asset category.
No, I appreciate those insights and perspective, Ray. That's helpful. I don't think the fact that it in the past has been a crowded space, and I think you're right. I think that as a public pension plan, at least 10 years ago, perhaps we were a less attractive potential investor because of typically the legal requirements that we have are more stringent than a family office or say an endowment. Things change though, the venture capitalists, funds that are out there may be more open-minded to different investors and different legal requirements, given what's going on in the market today. So I mean, I'd be open-minded to test in the water and see if we can implement and execute to the extent you would approve and increase in venture capital. There's another way to think about it, though. We obviously would need to build up either expertise internally within the Bureau of Asset Management, and that would fall under Anash Kudzela, who's highly skilled across all asset classes. But there is a unique set of evaluations and considerations that go into looking at venture capital versus, say, buyout or growth private equity. Or you can outsource that. We can invest through a fund-to-fund structure where it may have a slightly higher level of fees, but it could be a great way to kind of leg back into the subsector and get some great performance.
So
well, we look forward to those discussions, Steve. Thank you.
Great. Thanks, Frank.
So I just want to make a point that I think Ray just alluded to about sizing. And I just want to remind trustees to look internally when you think about the asset sizes. A $5 million investment at a $70 or $80 billion fund is much different than a $5 or $10 million investment at a $7 billion fund. So when you talk to your colleagues on the other systems, just be mindful of the fact that with respect to NYCERS, you're one of the largest systems all by yourselves without the assets of the other funds, whereas other systems in the city are not in your universe as far as what the type of sizing of deals that they would be doing. So I just want to remind folks that your asset allocation, while it may look similar to other systems at the end, will be, the implementation piece that I addressed earlier is where there'll be the difference in the sizing of the deals and the opportunity set. And I just want to remind folks that each of the 5 funds, and I know people talk to one another, they are unique in their liabilities, they are unique in their strategies, and they are unique with the size of money that they put out to work. And certain investments may be more appropriate at the end of the day for one system versus another. They may be appropriate for all 5. I think that those will be the implementation questions that we discuss as individual boards. And I just kind of wanted to throw that out there because Ray made a great point of alluding to the sizing of venture capital in general, and sometimes large systems have a very difficult time investing in small deals. And I think Steve was dead on to point out there are fund-to-fund strategies that would allow for broader investment. But I just want to remind trustees that have not been through this before that the issues at NYCERS and the issues at BERS for purposes of this meeting are aligned, but are not necessarily the same. So I just wanted to make that make that comment. So if there's any other questions for Ed or Steve, seeing none, I would make a motion to exit public session and enter into executive session.
I'll second that motion, John.
Thank you, Brian. I don't think we need a roll call. I think all those in favor could just indicate by saying aye. Aye.
Aye.
All right, and I believe that hearing no objections, we can go into executive session. So Melanie, a motion's been made and seconded. The board has approved going into public session. We are now in public session.
The board agreed to commit funds to an infrastructure investment. The details will be released at a later date.
So with that, I'd like to make a motion to adjourn.
I second that motion.
Thank you, Robin. All those in favor, please indicate by saying aye.
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 Any opposed? No abstentions? Thank you all. And Brian, thank you for letting me expedite that at the end.
Thank you, John.
Thanks, everyone.
Bye.
Thank you, Robin, for looking out for me.
Thank you.